Hi, this is Alan Gassman. Welcome to Monday, January 26, 2015. You've made it to the end of the day, and now a special treat for you. We're going to talk about life insurance product illustrations, proper uses, and also questionable practices. I'm very, very pleased that we were able to have Barry Flagg from Verilict here today. We're going to introduce Barry, but first let me give you a couple of preliminary comments or statements here. Upcoming webinars, please remember to consider attending these or tell your friends or your enemies about them. BP claims webinar, you're going to have probably a 6-month deadline here now on making BP claims. The methods of accounting have changed, so a lot of people who were told they did not have claims actually do have claims. There's going to be a lot of confusion with the CPAs so busy with tax return season. So please tune in for Tuesday, February 17. John Goldsmith is quite an expert in this area. We're going to have a lot of important discussion. Then Barry and I are going to do a series on life insurance. You can see we're going to talk about hybrid life insurance products on Wednesday, February 18. I'm really looking forward to that. We're going to talk about premium financing, what you do when you leverage or borrow from a financial institution to buy life insurance on Wednesday, March 4th. We're going to talk about split dollar life insurance on Tuesday, March 17. Please notice that these are very short sessions, 15 minutes each. The pressure is really on Barry to make it very clear what we're doing. And then March 31st, we're going to talk about comparing the financial strength and risks associated with different life insurance carriers. That's going to be also very interesting. Also note here, February 19, how to handle stressful matters in an ethical way. That's going to provide a 1-hour ethics credit for lawyers and CPAs. And all of those webinars that I just mentioned are free of charge, of course. Also, the Structuring Joint Exempt Step-Up Trust, I don't believe that that's a free one. I think that's one that we're doing for another source, but if you're interested, let us know. We'll get you a discount. So you've got my email address, agassman@gassmanpa.com. Also, I wanted to mention May 7th and May 8th, we're going to have an asset protection conference, Florida Bar Tax Section. We've had this every year now for about 20 years, but we're going to start a Thursday, day one, introduction fundamentals level conference, and it is going to be absolutely wonderful. If you look at the speakers we have here, they are world-class, including Professor Hesch, including Dennis Kleinfeld, including Howard Fisher from California. And then on Thursday, we're going to have, on Friday, the 8th, we will have an advanced discussion day. You can register for 1 day or 2 days. If you have associates who haven't really done this type of work or want to get a good background, the fundamentals day on Thursday will be great, and we will make sure that anyone who attends Thursday will know enough to get a lot out of Friday. There will be networking. There will be a dinner Thursday night, so we hope you're interested in that and that you can attend. Our new book on The Advisor's Guide to Counseling Same-Sex Couples is available on Kindle for $1.99. If you can't afford it, give me a call and I'll loan you the money. And now about Barry Flagg. Barry, do you want to give us a little bit of background? You have a very, very impressive track record.
Thanks, Alan. The short of it is I started in the investment business, started my career in a pension investment advisory department as a junior investment analyst, got familiar with how the fiduciary world works, how prudent investor principles apply to investments, sought to get some diversity in my experience, went to go work for a life insurance agency, and for those who saw the picture on the first page know I'm only half kidding when I say I pulled my hair out trying to do the most basic, fundamental, simple research, or that was simple in the investment business with tools like Morningstar, and was literally impossible in the insurance business. And part of that had to do with our topic today, is the use and what are now the questionable practices surrounding life insurance illustrations. Alan, do you have something you want to talk about with Notre Dame?
Yeah, we'll skip that. Go ahead. Let's go ahead and.
Okay. So these when I first entered the life insurance segment of the financial services business, about the only decision support tool were these illustrations. And to this day, it's even commented in the CLU curriculum, that nearly every decision to buy a life insurance policy, to do a 1035 exchange of a life insurance policy, to surrender a policy or lapse it, to consider a trade, or another word for trade would be a sale on the life settlement secondary market. Every one of these decisions involves the use of and the reliance on an illustration of hypothetical policy values. In other words, these life insurance illustrations are the principal decision support tool for most every policy management decision. Leading up to the 1970s, this was not the case. Prior to the advent of computers and these illustrations and universal life, life insurance products, at least permanent life insurance products or cash value life insurance products, consisted solely of whole life, where the rates, the policy, and the performance expectations were set by actuaries. They were published in a rate book. The agent or broker carried the rate book with them, and the rate was the rate. And it was a much more regulated world or regulated environment. There was just not that much difference between whole life product A and whole life product B. You fast forward to the advent of computers and universal life, and then these hypothetical illustrations. The pricing and performance expectations are now set at the point of sale or by the broker or the advisors or the client, and there is at least much less regulation, and in the early days there was almost no regulation about how these illustrations should or shouldn't be used. And so in that every decision is only as good as the information used to make those decisions, it is essential that it's essential to good life insurance purchase or management decisions to understand the proper uses of these illustrations and the practices that are now considered questionable. The good news is that we've got growing guidance for what is a proper use of an illustration and what is a questionable use of an illustration, although this is relatively new guidance, and so it is not yet widely adhered to throughout the industry, which probably makes webinars like this all the more important. Most notably, in 1993, the first of model regulations promulgated by the National Association of Insurance Commissioners was adopted, and the goals of this regulation were to ensure that illustrations do not mislead purchasers of insurance and to make illustrations more understandable. Of course, the only reason why you would promulgate such rules is that there was some disconnect, that illustrations were not accurately projecting or reliably projecting what the client can reasonably expect, or that they were not very understandable. And the illustration is not a legal document. The policy contract is the document or the instrument that dictates the terms of the deal, if you will. But very few people, in my experience anyway, very few people actually read the policy contract. Most people rely on these illustrations, and that has resulted in considerable disappointment that I've seen over the course of my career. And there's a case called Cochran versus Key Bank that is a poster child for how reliance on these illustrations have resulted in more disappointment than a reliable measure. So the model regulation was issued to ensure that illustrations are not misleading, or to provide rules that protect consumers and foster consumer education. And the most recent update, which is in process now, is so even to this day, so this is since these regulations have been evolving since 1993, and even to this day, they're addressing a lack of uniform practice, which results in illustrations that look like they're apples to apples, but are actually apples versus oranges. So let's look at a couple of examples. We're going to look at examples for the various types of cash value products, the first of which is whole life. We'll also look at the various forms of universal life, which consist of the original iteration of universal life, which is now referred to as current assumption universal life, to differ it from the other types of universal life, which is guaranteed universal life, indexed universal life, and variable universal life. All life insurance policies, the pricing and performance expectations of all life insurance policies is a function of really just two things: what the insurance company deducts for cost of insurance charges and expenses, and what is reasonable to expect in the way of interest or earnings or dividends credited back to the policy. And all cash value life insurance policies have both guaranteed elements and non-guaranteed elements. So in a complete illustration, you will find a page that looks like this that reflects, again, the terms of the deal set forth in the policy contract, but showing it numerically. These are some of the expectations that I was going to say that can be reasonable to expect, but we're going to talk about the reasonableness of some of it. And so there are the guaranteed elements, which is the maximum amount in a whole life policy, which is the maximum amount that an insurance company can charge for cost of insurance charges and expenses, and the minimum amount of interest that they are allowed to credit. And in addition, most every policy that we're going to talk about this morning has costs and performance that is better than the maximum that the insurance company is allowed to charge and the minimum that they're allowed to credit. And so then there will be a second set of columns that show what could be expected based on the rates filed with the State Department of Insurance for costs and the currently declared interest. And I'm going to come back to that currently declared interest. The rates filed with the State Department of Insurance are relatively stable. For an insurance company to change those rates, they have to go get approval from the State Departments of Insurance, which is some 50 State Departments of Insurance. They have to have a reason to change them. They have to have justification to change them. So the costs are relatively stable. But we're going to spend a fair amount of time this morning talking about the currently declared interest and how that impacts the policy. One thing it impacts is the dividend, which is a unique characteristic of a whole life policy. A whole life policy has a dividend that is a refund of over-collected expenses. So the way a whole life policy works is they charge the maximum, which is shown on the left side of the page, and then they refund the difference between that maximum charge and what their actual operating experience and actual mortality experience is. And the dividend also includes a credit of the excess interest. So in the columns on the left-hand side of the page, that reflects the minimum guaranteed amount of interest that they are required to charge, and then in the left-hand column, in the right-hand columns, in the non-guaranteed columns, it reflects the difference between what they're actually expecting to get or projecting to get and that guarantee. So it's a refund of a dividend is not a dividend like in a stock. A dividend is a refund of excess, of over-collected charges and a credit of excess interest. Another unique, so one of the things that's really important is what is that dividend interest crediting rate that is assumed in the illustration. There is whole life policies are required by regulation to invest in high-grade bonds and government-backed mortgages predominantly as a practical matter. So what is that dividend interest crediting rate? They have been as high as 8, 9, 10%, but the actual historical performance for the high-grade bond and government-backed mortgage asset class is between 5 and 6%. So one of the important things to do in determining the reliability of the expectation set for these illustrations is to examine or question or ask about what is the interest crediting rate assumed in the dividend on whole life policies. Another unique defining characteristic of whole life policies is that they have a guaranteed maximum premium. The premium, the total amount of premiums is not guaranteed, or well, I guess the total maximum premium is guaranteed, but the annual amount is guaranteed to be, in this case, no more than $55,000. The dividend that we just talked about can be used to offset or actually pay that premium. So even though the guaranteed maximum is $55,000 a year in all years, as shown on this illustration, the actual amount that may be paid, or that is usually paid, is not $55,000 in all years. It's $55,000 for some number of years, and then the policy, that premium gets paid by either previously accumulated dividends or the dividend, or some combination of the two. And then I said earlier that the pricing and the performance of all policies is a function of expenses and the expenses actually on file with the State Department of Insurance, and then some earnings assumption. And so the cash value is the column that shows what is projected to be left over after the policy owner pays the premium, after expenses are deducted, and after interest is credited. And on the far left-hand side, or on the left-hand columns, it shows the guaranteed maximum expenses and guaranteed minimum interest, and on the right-hand side, it shows the expenses currently on file with the State Department of Insurance, and some interest rate that again is disclosed elsewhere in this illustration, and we'll see in other illustrations, but that is part of the due diligence, the questions that need to be asked about the policy. And then life insurance policies obviously all have death benefits. The death benefit in a whole life policy is typically equal to the face amount, unless dividends are used to buy additional insurance, and then the dividends make the death benefit go up over time. If those accumulated dividends are then used to pay premiums, then the death benefit would come back down. And that is a somewhat unique attribute of whole life policies. Here we have a universal life example, and this is kind of the original version of universal life, which again now is called current assumption universal life to distinguish it from the other iterations that have since been developed. In universal life policies also, their cash values are required by regulation as a practical matter to be invested predominantly in high-grade bonds and government-backed mortgages. So while I said before that whole life policies, but really any policy where the cash values are invested in high-grade bonds and government-backed mortgages, if the illustration rate was 7, 8, or 9%, then it would be prudent to ask some questions as to how that might be achievable over a long period of time, given the historical performance of the high-grade bond and government-backed mortgage asset classes is between 5 and 6%. Here we see the inverse. In this universal life policy, in this universal life policy, the current interest rate is 3.1%. Currently declared interest rate is 3.1%. That is a function of the current low interest rate environment we're in, which 3.1% is certainly not a bad rate of return in this environment. However, that rate of return in this illustration is being used for 50 years. So that is arguably an equally unreasonable, albeit conservative rather than aggressive, an equally unreasonable interest earnings assumption on this universal life policy, whose cash values have to be invested in high-grade bonds and government-backed mortgages that have historically averaged between 5 and 6%. That means that premium that we're looking at there, while not guaranteed, because universal life policies don't have they have guaranteed elements but not guaranteed premiums, that premium may very likely be higher than what is necessary to pay, but because the insurance company is required to use nothing more than their current rate, whatever that rate is, in a low interest rate environment, that probably results in overly conservative illustrations. And then, just like I said before, for all permanent insurance policies, and like in whole life and like in universal life, whether it's disclosed or not, and we'll come back to that, the policy value is simply the premium minus the expenses plus the interest credited, here being illustrated to be 3.1% on a non-guaranteed basis or 3% on a guaranteed basis. And then something that's more common in universal life than whole life, although it's not non-existent in whole life, is the notion of a surrender charge, that the policy value is what's actually in the account. It's the premium minus the expenses plus the interest. In addition, universal life policies frequently have what's called a surrender charge, or a restriction on access to those account values. So the values are in the account. When interest is calculated, it's calculated on the full amount shown in that policy value column, but you can't get access to all of it. You can withdraw or borrow all or most of what's shown in the surrender value column, and then if you surrender the policy, that would also be the value that you would get. And then lastly, the death benefit under a universal life policy is most often a level death benefit, but like whole life, it can be an increasing death benefit, although calculated differently. The death benefit can be, if chosen at the policy application, it can be equal to the face amount, which we're seeing here as $1 million, plus the policy value or the surrender value. So it would be increasing, but it would be increasing by an amount equal to the columns to the left of the death benefit. Moving on to what was the next iteration of universal life, guaranteed universal life. And this is, it's universal life, typically, or at least initially, with a rider on it called a secondary death benefit guarantee rider that added guarantees. It made it look a little more like whole life insurance in some ways, in that there was a premium guarantee, and a lot like term insurance, actually, in its earlier iterations. Once again, though, it is universal life, and recent regulatory actions regarding reserves have made them look a little less like term insurance. So we once again have a rate of return. So this policy, this guaranteed universal life policy, is available for sale right now, just like the current assumption universal life policy we just looked at. It was available for sale. And here you have one company crediting 4.5% current interest, and another company crediting 3.1% current interest. In a fixed income environment, that is a huge, huge difference. That is a difference that probably won't exist, almost certainly would not exist over long periods of time. There will be a migration to the mean, and because, again, guaranteed universal life policies have to, it's a universal life policy, so they have to invest cash values in high-grade bonds and government-backed mortgages, which means that they're likely to experience a 5 to 6% rate of return over time, and so this also may understate the cash values a little bit. But it has guarantees in addition to just the current performance. In this particular case, if the policy owner paid that $37,315 premium on time, year in, year out, regardless of what the cash values did, even if the cash values went to zero, this policy would still pay a death benefit. It's important to note, however, I said that it looked, smelled, and tasted a little bit like, more like term insurance in the old days. A defining difference of guaranteed universal life is that the premiums, you don't have the same flexibility in timing of premium payment. For term insurance, and whole life for that matter, there's a premium due date, you have 30 days to pay the premium without any consequences whatsoever. In guaranteed universal life, if you pay the premium 30 days late, you can lose your guarantees. If you pay the premium 30 days early, there are circumstances in which you could lose the guarantees. So the timing of premium payment is particularly important in guaranteed universal life. And since it is a universal life policy, the same math applies. Premiums minus expenses plus interest is the account value, and then there is a surrender value or a surrender charge that restricts access to the account values, or it results in a charge on surrender that means you would get back less than the account value. Guaranteed universal life also can have an increasing death benefit, but is much less likely, or I see it much less often. The guaranteed universal life death benefits are more commonly level. There is an exception to that, which maybe we can talk about in another webinar, but more often than not, they're level. So with that, let's move on to the next iteration, which is kind of the current flavor of the day product, indexed universal life. Indexed universal life is a universal life policy. So its cash values, and this is something this is not as understood. I don't find it being as well understood in the marketplace. That cash values, as a universal policy, cash values must be invested also in high-grade bonds and government-backed mortgages. I have found too many people think that an indexed universal life policy invests the cash values in some equity index, and that is simply not the case. The cash values themselves are invested in high-grade bonds and government-backed mortgages. Then the interest from those high-grade bonds and government-backed mortgages, that is what is used to purchase options on some equity index. So once again, as a universal life policy, it is important that the policies that will perform better are the ones that have a good track record of generating higher levels of interest from their general account of high-grade bonds and government-backed mortgages, because the more interest generated from that account, the more available to buy these options, and the more that you buy the options, the better chance you have of getting an enhanced return. The flip side is also true, though, which is for every enhancement there is a risk. If you use the interest that would otherwise be credited to the policy, if you use the interest to buy options instead of going to the growth of the cash value account, those options could expire without value. So instead of getting an enhanced return, you might not get any return at all, which is not very often reflected in these illustrations. So that's another element that in your due diligence, if your client is considering an index policy, part of the due diligence should be part of the due diligence should always be examining the reasonableness of the rate of return expectation. And with index products, it is particularly true because it's an all or nothing game. You either get interest or you don't. And as a universal life policy, it again follows the same math. Premiums are not guaranteed. There are guaranteed elements to the policy, but premiums are not guaranteed, just like they're not in any universal life policy. There is a planned premium. That premium minus expenses plus whatever the interest rate is the accumulated value, less the surrender charge would be what is accessible to the policy owner, or that would be returned to the policyholder upon surrender. And indexed universal life death benefits, much like current assumption universal life death benefits, can either be level, which is commonly referred to as option A or option 1, or increasing, which means that it's the face amount plus the accumulated value or plus the cash value, which is commonly referred to as option B or option 2. Lastly is variable life. Variable life is the only of the universal life products where cash values are not required to be invested in high-grade bonds and government-backed mortgages. They are invested at the policyholder's discretion into a variety of mutual fund-like separate accounts. So the interest rate is not chosen by the carrier or the carrier's actuaries or prevailing interest rates. The earnings rate is selected by the agent, broker, client, or advisors. And so it is important that that interest rate or that earnings rate correlate with, or at least that it be reasonable to expect for the asset allocation corresponding to the policy owner's risk profile. That is one of the most overlooked questions in my experience in choosing the rate of return on a variable life policy. If the conversation was about any other asset except life insurance, it would be taken for granted nowadays that the first question would be what's the asset allocation, the second question would be what's the rate of return to expect from that asset allocation, and then that's what the projection would be run at. And that's the way I would suggest it, or prudent investor principles suggest it should start with variable life as well. And as a universal life policy, same thing holds true. The premium is not guaranteed, but because we have, to the extent getting a higher rate of return is reasonable to expect, the higher the earnings inside the policy, then the more those earnings can pay cost of insurance charges and expenses, and the less that is needed from the policy owner in the way of premiums to pay cost of insurance charges and expenses. And again, as a universal life policy, it's got an accumulated value that is premiums minus expenses plus interest, and a surrender value that reflects the restrictions from the surrender charge. And again, the death benefit can be either level or face amount plus the cash value. One kind of side note, I'm finding life insurance is being discussed more and more as an asset. There was a session at Heckerling talking about life insurance managing life insurance as an asset. And while I accept that internal rate of return calculations are useful in many types of assets, unless you know the date of death of the insured, I don't know how useful the IRR is. I do know, I accept there are circumstances that the IRR calculation might be useful, but to suggest that you're going to get look at that column and you're going to get a 15% rate of return or whatever, unless you know the date of death, and the insurance company knows more about when the insured is going to pass than the insured does. Unless you know the date of death, I don't know how useful that column actually is. So I hope I've helped show how these illustrations can be used to help policy owners understand how a policy works, how different policies work, how different rates of return and different funding levels impact the policy. They are certainly useful for calculating what is a sufficient or an adequate premium to meet policy owner objectives. I think they're very useful to have a baseline for what is expected out of this policy, and over time testing the reasonableness of those expectations and the assumptions underlying those expectations, and making management decisions along the way, having that baseline to work off of. And certainly, many on this call are in the planning business. And if you're doing a plan and you're trying to figure out, how to fund an estate tax and what the impact on the other assets is going to be, incorporating the illustration is useful to incorporate in those financial plans or estate plans or doing cash flow planning. But something that I think too many practitioners, and in some cases some books even suggest that illustrations are useful for comparing costs or illustrated performance of different policies. And for reasons we're about to discuss, I don't think this is the case at all. In fact, it's not just a matter of I don't think it's the case. It is not the case at all. We've got new guidance, at least new since the advent of universal life, from the chief regulatory body of the insurance industry, and they concluded, they published a rule for its members that it is inappropriate to compare a life insurance policy with another based on hypothetical performance, because such comparisons can be misleading and are strictly prohibited. In addition, the Society of Actuaries, the chief actuarial body for the life insurance industry, commissioned a study concluding that illustrations should not be used for comparative performance purposes because doing so is fundamentally inappropriate. Not just inappropriate, but fundamentally inappropriate. And most recently, the chief regulatory body of the banking industry published a handbook for unique and hard-to-value assets, including life insurance, that cautioned these illustrations are subject to a high degree of fluctuation. Anything with a high degree of fluctuation is not a reliable measure of what can be expected 20, 30, 40 years out, and therefore should certainly not be compared to something else that is unreliable 20 or 30 or 40 years out. Instead, there is a growing number of practitioners who are looking to established prudent authorities or authorities for prudent investor decision making. Certainly the Prudent Investor Act provides guidance that probably is going to sound obvious, but just to cite it, while the use of the comparison of these illustrations is certainly questionable, at the risk of stating the obvious, prudent decision making involves the examination of information that bears importantly on the value of the security of any investment, including life insurance. And one of the key things discussed in the Prudent Investor Act is, at the risk of stating the obvious, costs. That it would be most prudent to incur only those costs that are reasonable and appropriate. So in every illustration, or in every complete illustration, there is the detail, at least every universal life illustration. Whole life illustrations we would need to discuss separately, and I don't think we have time, but the same principles apply. But in every universal life illustration, there is a disclosure of what is being charged for premium loads, state premium taxes, federal DAC taxes, sales loads, what's being charged for administrative expenses, what's being charged for cost of insurance charges, and what's being charged for investment expenses and cash value-based insurance expenses. A more prudent approach to comparing hypothetical cash values or hypothetical premiums would be looking into what is actually being charged inside the policy. Of course, that's a start because what's being charged without knowing how that relates to everything else in the universe is only step one. My interest in this subject matter is that if you take all those charges and you put them all in a database, which is what we've done, you can calculate the average cost of insurance charge and expense for any policy in any situation for any client. And once you know the average, you also know the standard deviation, and the standard deviation is about 80%. That's also been published in a number of other sources. So there's the worst rates and terms in the marketplace are 40% higher than the average cost, and the best rates and terms available in the entire marketplace are 40% below that average. So in a matter of time, no longer than it took me just to describe this chart, a policy owner can know not only what they're being charged, but how that relates to the universe of peer group alternatives. I've said more than once that the pricing and performance of any policy is a function of what's being charged, which we just discussed, and then what is reasonable to expect. And as you might imagine, the Prudent Investor Act also addresses that one of the things that prudent decision-making involves is setting reasonable expectations as to the expected total return. And I addressed when we were looking at the illustrations a number of circumstances where the reasonableness of the rate of return being used might be reasonable now, but it may not be reasonable for a period of 20, 30, 40, or 50 years. Ultimately, the rate of return that is most likely to be credited over time is, as I also alluded to, a function of the risk tolerance of the client. There have been a number of studies published that say that the asset allocation corresponding to that risk tolerance has or determines 85% of the total return. So what's the risk tolerance? What's the asset allocation for that risk tolerance? What's the time horizon that the decision is being made. And what does the client expect? Particularly in this low interest rate environment, historical data may suggest that a particular asset allocation can get 8%, but a client may not believe that that's achievable. And so reconciling client expectations, which is what we're all talking about, with historical data would, again, be a prudent thing to do. So I hope I've helped demonstrate that illustrations are certainly useful. They are certainly a useful tool for making planning decisions. But I hope I've also illustrated that, not just in my opinion, but as a matter of growing authority, these illustrations are not useful for making product suitability or selection decisions. That prudently determine the suitability or the selection of a policy examines what the company says they're going to charge. Those rates are on file with state departments of insurance. They are reasonably stable. And how reasonable is the rate of return expectation from invested assets and aligned cash values, which I hope I've demonstrated can be one of the bigger questions in these illustrations, even illustrations that are compliant with the model illustration regs. So with that, I think I'm over time. But Alan, I'd like to offer anybody who's interested, email me, and there are new standards for using the same universal decision-making framework widely accepted in the investment business, applying it to life insurance. That's some of what I alluded to today. I mentioned the Cochran case earlier. I was published in Trusted Estates writing about that case. I've got it down and dirty 3 questions to ask about every policy review. Policy reviews are very, very common, needed tool, but they're also a common sales and marketing tool. So asking 3 questions helps make sure that the review serves the client's needs. And then I'm happy to provide a complimentary Veralytic report to anybody on the call. I don't know that I'm over time, so I won't go into what the report consists of. If anybody has any questions there, welcome to email me.
Barry, thank you very much. That was excellent. I have one quick question. I've been told before that when you get an illustration, you want it prepared by the carrier, not the agent or the agency. What is that about?
So the model illustration regs apply to the carriers. They have to have a certifying actuary. The actuary actually has to certify annually that the illustration meets the standards set forth in the regs. So if you're getting an illustration from a carrier, a complete illustration from a carrier, then that is the most, I guess, reliable and verifiable source of policy information, policy performance data. I still have some questions as to that. It is important to ask additional questions even about those. But if you're getting an illustration that's other than from the carrier, it's not necessarily. It's not to say that it doesn't conform to those same rules, regulations, and constraints that are designed to protect the consumer. But you also don't know that it does.
I see. Okay, Barry, thank you very much. That was excellent. I'm looking forward to being with you on Wednesday, February 18, 2015, 5 p.m. for the hybrid life insurance product discussion. I know a lot of clients have been very disappointed when they found out what these things really are. We expect that Jerry Hesch is going to join us for that. Jerry was going to join us today, but we just got a message from him that he got in late last night from L.A. and just basically couldn't get out of bed. I don't blame him. It's probably a tough trip. I hope the weather for everybody is good this afternoon and that you go straight home and have a great dinner and cocktails with your favorite person. Good night. Thanks again, Barry.
You're welcome.